amazing the amount of crap people have that they're willing to pay someone to keep for them.
Like, I got no allegiance to self-storage. I don't actually even believe that it's a necessary service.
How do I see a path to making money here and other people don't? Hello and welcome to another edition of the Real Estate Anonymous podcast. Today we are heading to Roswell, New Mexico. Special guest with us, Baird Kleinsmith, the self-proclaimed Sultan of Storage. It's super interesting asset class, great cash yields. I've always been curious about this one, and so we're going to dig in and kind of learn why and how to make money at it. The other interesting development for listeners is Eric has shaved his beard, and it's a hard adjustment for all of us. All right, everyone, welcome in another edition of the Real Estate Anonymous podcast. Elliot White and Eric Weatherhultz with you as always. We've got a special guest today, the Sultan of Self-Storage. I suppose is a fair title. Baird Kleinsmith joins us. We're going to walk through a self-storage deal, which should be a ton of fun because I don't know anything about that space. Eric, do you know anything about that space?
Yeah, we've got a 580 of the dadgum things, unit-wise. Amazing. It's an amazing business.
So I sort of cynically have thought that it's just sort of a shed with a lock, but as an asset class. And I think it's a pretty lucrative one. I imagine there's tons of complexities, but I always sort of laugh about, like, Baird and I would be having a conversation. I'd talk about the 7 different sources we had to cobble together to come up with this affordable housing deal, and the partnership with the local housing authority and subordinate debt from HUD and like all these things. And I think I'm so smart. Look at me putting this deal together to get a 16 IRR. And Baird's like, I don't get out of bed for less than a 30. So I don't actually know who's smart, affordable guys or self-storage guys, but we haven't touched on one of these because we just don't know anything about it. And I like to be snarky about things we know. So I didn't know you guys had 580 units.
Well, units, yeah. In a project, we had a horrible shopping center that haven't been able to scrape off our shoe for years. A lot of bad decisions went into buying it and owning it, and then converted it to couldn't lease the space at any rate. Converted it to self-storage, created 508, I think it's 584 individual units, and just leased the absolute tar out of those things. It's amazing. It's amazing the amount of crap people have that they're willing to pay someone to keep for them. Baird's built a whole business out of it.
I've got a million questions for Baird about the psychology of self-storage renters. So we'll introduce Baird. Baird, first, thanks for coming on and joining the ambient chaos that is this thing. And 2, you want to just give people kind of a quick background, who you are, what you do, that kind of thing?
Yep. So I'm the, as you explained, I'm the self-proclaimed Sultan of Storage. I'm working on building a micro empire in the Southwest. So I spent 15 years in financial technology, leading business development teams. Started here in Durango, Colorado, with a startup 20 plus years ago, and then that took me over to London. Came back from London in late 2020, and I didn't want to continue the corporate career. I was desperate for something new. Had a little bit of money in my pocket that I had saved from that long career, and I was looking for what was next. Heard Nick Huber on a podcast, my first million podcast, back in November of 2020, and it just clicked for me that this could be what was next, and the rest is history. So over the next 3.5 years, I bought 10 self-storage properties in Colorado and New Mexico, sold one last year, and rolled the proceeds into my biggest deal I describe as the gem in the Sultan's turban. So I sold the first deal I bought. I sold for about a $900,000 gain last year. Rolled that gain into the purchase of a $12 million property that is the gem. And so now today I have 9 properties across Colorado and New Mexico.
And you've done this Beard the old-fashioned way with good old American debt.
Yep, good old. I've leveraged to the eyeballs. I've only used I've only used my own capital. I don't have any investors. So yeah, I've taken some serious risks, but it's paid off. Like my game is I find very mismanaged properties. In most cases, I'm buying them for a premium, like that $12 million deal I did last year. I bought for it at a 2.9% cap rate when the market was probably 7% for that asset. But that property is probably worth 15 to 17 million today. 10 months later.
Good for you. Fantastic.
Do you find that the competition is more intelligent in the fintech space or the self-storage space?
Fintech. I was I was a small fish in a big pond in fintech, and now I might be a whale in a little pond with storage. No, that's one of the things that we're talking about. This as an asset class. Like I got no allegiance to self-storage. I don't actually even believe that it's a necessary service. I mean, clearly it's a necessary service, but my brain is boggled when I open up some of these units and see what people are paying to store. But people have a need, and we're serving that need. But the thing there's two things that I love about storage. One is that it's really a small business operation that's tied to a real estate asset, and the ability to add value through small business operations then is reflected in the value of the real estate asset. And you get the benefit of real estate lending and tax treatment, all of that. And then the second piece that I love about storage is that the bar is very low. Competition is super weak. And apologies, I don't know if you guys can hear it, but there's a steam train that runs through our town, and it goes by a little bit after 8 every morning. So we'll have to edit out the train horn.
I will say cynically, I take lots of shots at VCs on Twitter. I'm not convinced that all fintech products are necessary. So your point about whether self-storage is a necessary thing or not, it's probably necessary. It could be more necessary than a lot of the like Uber for cats or one-click checkout stuff that you see.
Yeah, I mean, I joke that it's it's a luxury item. It's an unnecessary service, but in reality, you look at a lot of our customers are businesses that need extra space for inventory, supplies. Yeah. A lot of our customers are mid-move, or they've gone through some life event, death, divorce, displacement. So there are definitely those customers that are paying hundreds of dollars a month to store items that are worth far less than what they've spent. But there's a good chunk of customers that actually have a real need for space.
How many times per year does the average person go to their self-storage unit?
That's a great question. I don't have the specific data, but it is a very small percent. Like we have some smart gate systems that allow us to track movement in and out of the facility, and it's a super small percent that regularly visit their units.
That's kind of what I thought.
And our managers use that, tracking. If someone is accessing their unit often, it's often something nefarious. A, they might be sleeping in it. And then B, if they're going in and out on a daily basis or close to it, there's usually something else that's up.
I wonder what the overlap is between the daily use customers at your self-storage facility and the residents at some of our housing projects. I wonder if the street entrepreneur overlap exists.
I could see you might have some Breaking Bad stuff going down in your New Mexico deals there.
Yeah, you might.
It's certainly possible. It's certainly possible.
Baird, do you want people to get in touch with you, and if you do, how would people get in touch with you? Or if the answer is no, leave me.
Yeah. I love connecting with strangers on the internet. They can find me on X, formerly known as Twitter, as at Sultan of Storage. And then I'm also on LinkedIn as my real name, Baird Kleinsmith. I'm the only Baird Kleinsmith on LinkedIn, so pretty easy to find there. And then folks can email me, baird@sultanofstorage.com.
So what service, Elliot, do you think this podcast serves? I mean, is this a necessary thing? Last week we talked about it as a digital gathering place for dumb guys.
Yeah, I still think that's right. I think the purpose that this podcast serves is like, if you are sort of dim-witted and sporadically interested in real estate, you can be like, oh, these are like-minded guys. I think if
these are my people.
These are my people. Yeah. I think if what you're looking for in your life is really highbrow discourse and advanced financial concepts, I don't think that this is the place for you. I don't think real estate is the place for you, but this is.
You're not going to find a white paper here.
You're not going to find a white paper. No, God, no. No, I think that this podcast is far from necessary, but fun. And I think reasonably entertaining. That's probably the best you could hope for. And maybe you learn something, like I hope we learned about self-storage from Baird here today. You hopefully learn something that if you're ever at a party with a group of people, you can come off as sounding one kind of tier brighter than they are about a certain thing.
Well, here's one. I met with some cats yesterday that are building a 57-story tower here in Atlanta, and they started pouring concrete 6 months ago. They pour it every day, and their schedule has them finishing the concrete pour in November of next year.
That seems no good.
Isn't that incredible?
The
scale of some of these projects is, once you really get into it, is kind of staggering.
I could never do that. I think that's why I'm in storage, because I'm too dumb and impatient.
That's why we're having you on to join us. And you think about, I was sitting there thinking of time that these things take, and when you conceived of the idea, you bought that land, you started that construction. By the time you finish that construction, the world, think of the changes that have happened and will continue to change in the world by the time that you're delivering it. So speculating on outcomes with $500 million in a project of that scale as to where you're going to end up in 3, 4, 5 years is fantastic.
We talked about this a little bit, I maybe on the last episode, about understanding the motivations of different buyers and operators in the market, because you hear about the KKR purchase and you hear about some of these splashy portfolios that Blackstone will buy or whatever, and the cap rates and the price per unit. And you think, how does that make sense? And what they're betting on is, we think rents, though maybe flat to declining currently, there's a lack of supply coming, so we believe those will trend up. That's kind of the first thing. Second thing is, we believe that the 10-year is going to drop to 3.5, 3.25. And so we're building to a development spread of 525. And even though that sounds thin, it represents an attractive yield, or, to the risk that you're taking. I don't know. I'm not saying that they're wrong. I'm just saying I don't have the stones for that business. But some of these guys are making huge bets like that. And it's pretty interesting to see their motives. I think Baird probably takes the other view of real estate investing of like, I'm going to buy a thing that I fundamentally understand, because there's not as many moving parts as a huge Class A development. And I know that if I do these two things, I pull these two levers, I'm going to drive 90% of my return. That's more, I think, probably how Eric sees things. I think that's how I see things. Baird, I assume that's true in your space. Like, you're not taking some macro view of I'm going to hold this because the future tailwinds look really strong. You think I'm going to buy this, you turn chicken into chicken salad. That's the business that we're in. Yeah,
it is. Yeah, and my primary motivation is cash flow. Like I have an IRR calculation in my underwriting model, but it's for shits and giggles. I'm not targeting some long-term return. I'm purely trying to maximize my cash on cash return. A little bit different than that.
You're saying, can I get more rent than the last guy?
Yeah, I don't care what the last guy was doing. Like I take a glance at the prior owner's financials, mostly to look at some of the costs. Like, utility costs, insurance, property taxes. But I know what it costs me to run a property, and then I look at what I think I can get in rates. And in most cases, I'm buying very mismanaged properties with very far below market pricing. And my thesis is that I can get pricing at or even above. In most cases, I'm the most expensive property in my markets, and I can, and I operate at super thin, operating costs. Like I typically am, my portfolio as a whole is at like 75% net operating income margins. I think the deal or two that we're going to look at today, I struggled to get them below like 80% net operating income margins, just because I run these things super, super lean. And I think part of that is that I don't have investors. I'm not collecting, property management fees. I run my customer service business at a break even, and I think that allows me to I think something.
And no on-site managers.
Nope. Like, that property I bought in October, it's 115,000 square feet, 776 units. They had a full-time 5-day-a-week on-site office manager. I've replaced him with a team of 4 folks in Latin America that answer the phones 10 hours a day for 7 days a week. And they were at 72% physical occupancy. We're at 93% physical occupancy. And that property was run that way for 15 years before I bought it. We switch I think out of the 9 properties that I've bought, or the 10 properties that I bought, about half of them had on-site managers, and most, all their rentals were happening in an office on paper. Now 100% of our rentals are done virtually, either over the phone or on our website.
Baird, how much, right, you left what is a pretty challenging environment in fintech. When you were looking at some of these investments, how often did you initially think, I got to be missing something? It can't be quite as, I'm not saying your job is simple, but it can't be quite as straightforward as it seems. Was there a period of time where you were like, I think I understand it, but I got to be missing something? Because how do I see a path to making money here and other people don't?
Oh, yeah, absolutely. I think probably my first 6 deals, I still I wasn't sure about them. I mean, the first one looked good on paper. I recognized that I didn't know anything, so I reached out to a couple of pros for their guidance, and I got third party validation from people that were much more experienced than me that first deal looked good, and then the rest of them I took a leap. But yeah, for the first year or two, I questioned every decision I made to buy a property.
And how much cash, if someone's wanting to get into self-storage, what's kind of the minimum amount of equity they need to buy a reasonable deal? Because it's got to be hard to do with 4 units, right? There's like a certain minimum economy of scale. So if you want to do this, you need what, $500,000, or you need $4 million, or what's the? If someone's listening to this and they want to get started investing in self-storage, what's that number?
It depends on the scale that somebody wants to reach. Assuming your first deal is like a $1 to $2 million deal, you need to be prepared to bring 20 to 30%. So you should be prepared. If you're going to buy $2 million, you should probably be prepared with $500,000 plus in money that you can put into it. And then I always keep a large cash reserve, because you just never know the capex that you might need to spend. And then I also just, you never know what happens. And I don't want to be stuck in a situation where I don't have cash to pay my bills.
I know several multifamily syndicators who are in that exact position right now, and we are bidding on their loans. So before we jump into this deal, I think the most important question, Eric, did you shave your beard? Did you trim your beard? Did something happen?
Yeah, I'm
new
turning
lighting?
up for a new life. Yeah, I'm trying to get a little more polished for this podcast. We're trying to be professionals here.
what the hell's going on here, man? You just woke up and said, I'm cutting back.
I'm making some life changes. Okay.
I'm making life changes. All right. Well, let's get into Baird. Do you want to tell us kind of what you got? You can pull it up on the screen.
Yeah, sure.
Maybe just give everyone sort of a broad overview of the deal, where it is, how many units, that kind of stuff. And then any insight into how you look at it would be super interesting.
Yeah, let me share my screen. I've got two deals. Let's start with one. I'm gonna go with.
We only do good deals on this show, so make choices accordingly.
Yeah, we've got.
Like I was saying before, this is a surprisingly good deal for an on-market self-storage deal. This one, I wonder, like, what am I missing? Let's see if you can see my screen. Can you see this Enchanted Land self-storage Google Sheet?
Yeah, I can see that.
Cool. So this is an on-market property in Roswell, New Mexico. If you're not familiar with Roswell, it's down in the southeast corner of New Mexico, probably more similar to Oklahoma and Texas than it is New Mexico. But it's Roswell is the UFO capital of the world. It's famous for a supposed UFO crash in the 40s. Now home to the World UFO Museum. So that's its claim to fame. I actually have a couple of properties in a town that's not too far from this, so I know the region pretty well. This one's called Enchanted Land Self-Storage. It's on market with Hope Brothers out of Dallas. They do quite a bit of work in this part of New Mexico. And I got the broker's permission to use this as an example. This one, for anybody that
First
watches.
of all, what do you think about let's get to the important stuff first. What do you think about the name Enchanted Land Self-Storage?
I knew you were going to ask that. I knew it. As soon as you piped up, I knew that was going to be the question. Yeah.
I don't love
Does
it.
the name matter?
I found that name doesn't really matter. All of my properties are independently branded. In most cases, I just absorbed the brand that the prior owner had. In some cases, I've renamed AAA self-storage and even a 4A self-storage to more geographically focused names. Ideally, you have a name that reflects the local area. So, like Roswell storage would be pretty nice if it were available.
What about UFO storage?
Yeah, I think there's two properties with this same broker in Roswell where I got to think, you buy these two properties and you've got pretty dominant position in that market, and you could get pretty creative with that name, like, out of this world storage. Yeah.
There's an affordable housing group that I compete with and don't know them that well, but they have this sort of 5 IQ branding strategy. I think one of them went to get their MBA at Harvard or Stanford or what the ever. And the lesson was, you should have a brand. And so every property they buy, they brand it. I'm not going to say what the brand is because I don't want to, dog on them publicly, but all of their properties have the same brand. They have like a type of name, they call like the Heights at, and then whatever the name of the property is. But the problem with branding affordable housing projects is like Avalon. People go, I've stayed in Avalon. Those are nice. There's one near here. Like, okay, this is going to be a nice place. Most affordable housing projects, it's like, my cousin got shot at this deal. And all people have is largely a negative, association with affordable housing projects. So when you brand all your properties, that they all get dragged down by the worst performer.
Yeah. And you actually don't want brand notoriety.
You actually don't want, like I'm just some idiot from a public high school, but even I know, like, I don't think that's a great idea. Because then people are like, all those deals, they're shitholes. My cousin lived at one and they're all terrible. It's like, well, that's probably not true. Anyway,
the landings at semi-automatic.
Yeah, full clip terrace.
There you go.
Yeah. So anyway, I think you're onto something with your out of this world storage company.
I think it does. If you build a geographic presence with multiple properties, like I've got, I should rebrand my properties to one common brand, because I think, in my space, I've got a bunch of properties on highways in the area, and if you could be a recognized name, it probably helps. And then I think if there's some SEO benefit, if you have all your traffic from all the properties going to one sort of hub of a website, I think there's some value there, but I'm not there yet. I'll do that rebrand at some point. It just seems like a giant pain in the ass to me when things are working so well.
I agree that if you are in an asset class where things when they go wrong, they don't go like wildly wrong, that you could brand it and people like, oh yeah, they had a good quality product. I thought it was hysterical for affordable housing. Like, I kind of understand the kernel that led to this bad idea, but this is not a great idea.
Yeah, no, I agree with you.
So I'm looking here, you've got cash on cash seems quite attractive.
Yeah.
I'm going to assume this is your underwriting, right? This is not what the broker sent over. This is what you believe to be true.
Yep. This is my 5-minute underwriting. I plugged in the numbers in about 5 minutes. So if I'll just walk you through how I do this. So most of this information came from the broker's OM, and then some of it, when it comes to costs, I predict some of that just based on my experience with other properties. So I always start on this unit mix tab, and I just get the dimensions of all the units, the count of those units. These are their current prices from the broker's OM. In this case, I just use the broker's pro forma prices, which they don't look too far off. In fact, if anything, they might be a little bit conservative based on my experience in that adjacent market. So that it gives you their current gross potential income, and then your future gross potential income. And I found that you can flip the switch pretty quickly and do a pretty sizable increase. I'd probably step this one. I probably wouldn't do like a full 60% increase on all those customers that are in the 10 by 15 units. But I just assume that I can get to this over time. Again, speaking to my lack of sophistication, my model is really, really basic. And I'm sure that if anybody got into this sheet, they could poke a ton of holes into it. I'm not like very sophisticated when it comes to like staggering those rent increases. My model sort of assumes that in month 3, I just get everybody up to that optimized pricing. And then I see like a pretty significant decrease in occupancy in the month following, and then step back up to sort of an ongoing occupancy.
When you're buying from these sort of entrepreneurial mom and pop owners, do you do any due diligence on, are the spaces actually rented and are the people actually paying?
That's a very good question. I would say I do some due diligence on that. The big example that I gave earlier, I did not do enough, and I thought I was buying about 100,000 square foot property that was 90% full. Turns out I bought 115,000 square foot property that was about 70% full. So that's a good example that my due diligence is not great. Like I was surprised by additional square footage that I found after I closed, which is surprising that wasn't identified in the appraisal. And then in that situation, I knew something was up with that one. When I looked at their rent roll, their occupied rent roll, it should have been generating 105, 110,000 a month in revenue, but it was generating 50,000 in revenue. So I knew something was wrong there. In the DD, what I found was that it was just pure negligence. It was the owner of the property was a builder. He hired his son to manage it. His son lost complete control of it, and I think it snowballed over 15 years. And when we took that property over, we found, it was probably half the property half the rent roll was not accurate. Customers were in wrong units. We had a couple hundred customers respond that they didn't have units at the property. Some had never had units at the property. Some told us they'd moved 10 years ago. Others said I have no idea why I'm getting this intro email from you. And we ended up we ended up cutting locks off of 200 units just to try to figure out who was in them. Like I was in these units crawling over, 10 years of dust just to try to find shipping labels to identify who was in the unit. My team did an amazing job of investigation, using some tools to try to track people down. We ended up auctioning 50 units that were just clearly abandoned, didn't have anything of significant value, and then probably reunited dozens of folks with stuff that they thought had been sold long ago.
That's been kind of the whole thesis with these independent self-storage businesses. It's one of the only very few asset classes where there's this pricing aberrations that come from disinterested, unsophisticated owners. It'd be rare to find a Midtown Manhattan Class A office where they didn't know that the building was 15% larger than it is.
Yeah. Yep.
Or that, that the rent hadn't been collected on 25% of the space. So it seems like that the trick with this business, unlike, or maybe more so than others, is just finding the right deals to begin with. I mean, you can say that about any business, but there's some real outliers in acquiring existing self-storage that if you can find the dumb owner or an owner that's dumber than you, that's kind of the whole trick to this game.
Yeah, this one's a perfect example. It looks like it's physically a very nice property. I haven't visited their website. I don't know if they're using any software, but I can just tell based on their prices that they're not running it properly. I mean, they're 20 to 60% below market with their prices. In this situation, I bet this owner doesn't have much debt. He's clearing 6 figures a year. He didn't have a need to push prices. Whereas I come in and I lever 80% into this deal. I gotta adjust prices to pay my debt.
So you've got cash on cash that's going from year one around a 15 that trends up to high 20s.
Yep.
And I don't know if those are typical returns for your space or not. They're obviously super attractive. As you get into either bigger facilities or portfolios that have been rolled up, you must see those returns getting compressed? Like there's got to be a sweet spot where you don't want to buy deals that are too big, because then there starts to be a little bit more pricing perfection.
Yeah. I think generally that's accurate. And these cash on cash returns these are crazy high for most folks. I'd say for me, this is actually about where I want things to look for me to even just do a deal. I think on whole, my portfolio runs at like a 35 to 40% cash on cash return. Deals have just performed much better than I expected. But yeah, I mean, you look at the most broker OMs are bragging about a high single digit cash on cash return.
Yep.
And the debt on these is this sort of community bank, local bank, floating rate, 5-year term kind of stuff, or are you getting some fixed rate?
I assume that on this property I would bring 20%. So I've got a local bank in Colorado that will fund deals in this part of New Mexico. And if I'm doing a conventional non-SBA loan on this, they're going to have me bring 20% down. I'm experienced. I've got a track record with them. And so if this were just somebody walking in off the street, that probably need to be 30% down. But I'm, in this case, I'm assuming a conventional loan from a small community bank. Guessing the interest rate is around 7%. They'll give a 25-year amortization.
And how long of a term?
So typically, I'd expect 5 years for that interest rate to be fixed. In my cases, my existing properties are anywhere from 5-year to 10-year. I've got one where the seller gave me the full 20 years fixed at 5%. But yeah, in most cases, if you're financing with a smaller bank, they're going to require an adjust or a balloon in 5 years.
And full personal guarantee.
Yep, full PG on all of this. My goal is someday to refinance into non-recourse debt.
Eric's a fan of non-recourse.
That's a sweet world when you can get it.
I'm also a fan of non-recourse. So on something like this, there's the cash on cash is attractive. The rents are cheap, but I assume there's still stuff that goes wrong, not really operations, but there are physical improvements that need to be made to the structure either before you take over or ongoing. How much are you setting aside for capital reserves? Because, $200 a month for a storage unit is great, but it could be temperature controlled and your HVAC system still costs thousands of dollars. Like you kind of have a rent that can be tough to offset a large capital event. So how much time do you spend doing physical diligence? How much money are you putting in up front on a typical deal? And then how much are you setting aside over the life of the hold period?
Yeah, so it varies, but I try to buy physically nice, operationally disastrous properties. And this one seems to match that. Like I don't know when the buildings were built, but just looking at the photos that are in the OM, it looks like a fairly new property. It's got asphalt driveways that from the overhead pictures look like are in good shape. It's got it's got nice signs, and even on this one, I noticed on the road sign it mentions that every unit is alarmed and monitored, which to me, I know there are solutions where you can actually place like a monitoring device in the units that then alert the tenant if the unit's been accessed. I would be really surprised if these guys implemented such an advanced tech solution, but maybe they have. But in this case, I've budgeted pretty minimal capex. Like I assume that I need to upgrade the security camera system. That cost me about 15 grand. New signs with out of this world storage branding for $3,000. Title's pretty minimal. My attorney could do this for less than $2,000, and then I figure some loan origination fees of $5,000. So this one is just 27 grand in addition to the $800,000 down payment. And then in the pro forma, I go through and pretty randomly select a repairs and maintenance budget. So in this case, I budgeted $1,500 a year. I expect that'll be pretty lumpy, but 10 to 15,000 a year in repair and maintenance reserves for a property that's physically nice like this is pretty reasonable.
Yeah, you said 1,500 a year, but 1,500 a month.
1,500 a month. So
yeah,
we're talking, what's that? 14,000 a year.
And the big expenses, the big capex on non-climate controlled stuff over time would be asphalt and maybe some roll-up door repairs and maybe a roof.
Yeah, but these things, the roofs, these buildings last a long time, and I've never had,
This is a metal. We haven't looked at pictures. This is a typical metal building.
Yep. These are concrete slabs and metal buildings with metal roofs. Sorry, I mentioned I can be successful in self-storage because I'm not that smart. My public math of that 1,500 times 12.
Yeah, it's 18,000. I didn't want to joke. That didn't seem nice to do to the guest.
Come on, I'm a storage bro. I can take it.
Yeah, your fintech days are long behind you.
Yeah, I can't multiply 1,500 times 12. It's a good thing I'm not in the finance world.
It must get hotter than in New Mexico in a metal storage unit in the sun. Yeah.
Oh, these things are probably 140 degrees inside in the summer. But again, I've got two properties without climate control that are in this same region, and I published some occupancy figures yesterday on Twitter, and those two are at 94 and 98% occupied. Getting towards the end of the summer, so we don't have an issue with not having climate control in that market. I wouldn't imagine we'd have that issue here either.
And on something like this, what is our basis per unit? What are we spending per square foot on this kind of thing?
So on this one, we've got 70,000 square feet. So let's take the purchase price divided by the square footage, and so this one would be $57 a square foot, which is like I look at that number just in my napkin math to see like am I buying this property for below, at, or above replacement cost, and this would be below replacement cost in this part. I would assume that you'd have to spend, not including land value, which land is cheap in this market. And that's one of the risks here is it's probably very easy to build new inventory in this market. But I would think that it's probably take, $70, $80 a square foot to replace this.
But if some dumb guy wanted to come in and compete with you, he's gonna have to charge significantly more or have the stomach. I think another trick with self-storage, or where you can get outflanked, is, an ambitious owner or a, owner with a different outlook or different capitalization can come in and drop rates to some unsustainably low rate, take all the tenants, and then boil the frog over the next 2 years and turn the rates back up. So you can get into. To me, self-storage has few weak spots, but that's one of them. Is there can be a competitive pricing and sort of a spiral to the bottom that you've got to be able to have a way to withstand that if some broad-shouldered investor landlord type comes in and starts cutting rates.
Yep, that's the biggest threat to self-storage is self-storage. Probably the biggest risk in buying this property is that somebody could come in and add a ton of new inventory to the market and force you into a price war. Somebody with deep pockets like a U-Haul might decide to come into this market and build a big Class A facility and drop their rates to the floor during lease up, which would certainly impact a property like this.
So how do you look at a market and know that there's too many self-storage units for the market?
Yeah, so some more sophisticated investors than me will run square foot per person in an area in like a 1-3-5 mile radius around the property. I've found that that's not a reliable metric, and the best metric for me is to call every facility in the area and figure out how full are they. So I assume that if every property is 95, 100% full in a market, then it's probably undersupplied, and you've got to and then you have to look at like how easy would it be for somebody to add new inventory. So most of my markets it'd be pretty hard to add new storage. Like it'd be hard to get new storage developments approved. I don't know what this market is like and what the barriers are, but in my due diligence, I would call the county planner or the city planner, figure out, are there any projects in the pipeline? Have they had any proposals? Try to get some gauge on how inventory levels might change in the future post-purchase.
And also by dealing in these tertiary markets, you're probably have a little bit of protection counterintuitively of if you're in a crappy market, there's probably less desire and demand to build new product.
Yeah, I mean, there's a reason that there's no REIT level properties in this market. They're all independent mom and pop. It's the demographics in this market are not great. It's the population is declining. The median incomes are not great. I think they're in the 50,000 a year. Which is higher than I expected, actually. But that's reflected in the pricing. Like these are really, really low prices. Property in Durango, Colorado, where I live, These 10 by 10 units are renting for 170 a month. So, quite a bit higher.
And then do you see any kind of, additional ways to tweak it other than ramping up rents? Is it an occupancy? Is it have you ever, or in this case, do you look at, can we add more units, or can we add boat storage, or can we, any of those sorts of things?
Yeah. Again, for me, like I'm not smart enough to evaluate new development. I've bought some properties that have some extra space that could be further developed, but I'm better at like taking something that's already there and standing and has customers in it and making it run right than building new buildings that I hope to fill up. Like with this,
the gotcha, if there is one with this, is probably not CapEx. The idea of somehow new inventory coming on market, or a pricing war of sorts. That's kind of what you got to get comfortable with.
Yeah, that seems to be the risk.
Yep, absolutely. But to be honest, this actually looks like a great deal to me. It's their prices
and the recourse nature of this stuff, so that if you were getting 25% kind of cash returns on a non-recourse basis, you can be like, well, if I can just hold on for 4 years, I got, in theory, get my money back. This one, you're on the hook for a larger amount. But I'll tell you what, Elliot, I'm a buyer.
I'm a buyer too.
Roswell, New Mexico.
Yeah, I'm a buyer. That's we always ask that question. I'm definitely a buyer. This is super interesting. I'm glad you came on here, Baird. It's a space that I've been interested in, and I see why you're in it.
Yeah, one thing to call out, like people will see this net operating income margin in the upper 70s. Like that's not normal. That I was sharing with you guys that my portfolio runs at about 75%. But when you get on a larger property like this, I actually struggled to get this below 80%. I was just like throwing additional costs here, like this $2,000 a month in contract labor. I don't think that I think that's a very high estimate. And this like property management, I run at sub 4% cost for my PM team. Most buyers are probably going to have much higher costs there. But yeah, I think I'm a buyer too. Like I said, I'm kicking myself. I heard from the broker this has multiple strong offers on it. It's going to go under contract soon. They've got another one just down the road in the same town that's also for sale and under contract. I wish I would have bought those two and become the Sultan of Storage in Roswell.
Sultan of Alien Storage.
Yeah. Sorry, guys. That's somebody calling one of my storage facilities to rent a unit.
I think that music could kind of go with Alien.
That's all right. It does go with Enchanted Lands. Well, this was super cool. I think we sort of answered all the questions that I have.
We don't have the Brett Moss deal bell, though.
We don't have the Brett Moss deal bell, but I think we're all buyers. I mean, Baird sounds like he's a buyer. I'm definitely a buyer. It's a cool space. It's not one that I could ever see me getting into. I've just far too much sunk cost into learning affordable housing that to pivot would be pretty hard for me to explain to myself. But I see why you do it, man. It seems like you can make good money at it. So,
well, thanks, guys. It was fun to walk through that one with you.
Yeah, this was great, Eric. I hope next week your beard is a little more robust. This is really throwing me off, man.
We'll get back in shape here.
You've changed, man. All right. Well, I think that's it.
Looking for a promotion.
Yeah. You guys got any closing comments?
Let's go to New Mexico. How about a road trip?
Let's go to New Mexico. All right. Thanks, everyone.
All right.